Great. So thanks everybody for joining us today. Again, my name is Philip Reeves from 1863 Ventures. I am joined today and super excited to be with Nick Jean-Baptiste from Jacmel Growth Partners. We want to have a conversation around growth. We know there's a lot of firms now thinking about how to take advantage of the opportunities presented through this environment. And so we're privileged to have a professional, an investor who's worked with a lot of companies and can provide us a lot of guidance. And so, Nick, I want to turn over to you to have you introduce yourself and your firm. Just give us a little bit about both.
Okay, great. Well, hey, Phil, first of all, thanks to you and Melissa for having me on. So happy to be helpful in any way possible. In terms about myself, so by profession, I am a private equity investor. But prior to that, worked on Wall Street for a number of years, and then worked at a growth private equity shop out of Utah called Peterson Partners, where at Peterson manage about $1.5 billion AUM. And the premise behind how they do business and the tenants is really about partnering with entrepreneurs to really help them achieve their dreams. And that's something I've really instilled in how I look at businesses and how I look at partnerships. It's really to come in and work with a CEO and owner, either in transition or for growth, to help them achieve their dreams, whatever that dream may be. I see how it is that I can come in and be helpful through capital and through different means. And so in 2016, as we were leaving Utah, having spent 3 years at Peterson and coming back to the East Coast, the thought was, hey, do you go back to work at another PE shop? Do you go back on Wall Street, or have you learned enough to really go out and pursue private equity on your own? Through just having a lot of great partners and mentors, such as Joel Peterson, the founder of Peterson Partners, also the chairman of JetBlue, decided it was the right time to just go out on my own. And luckily, I had a couple of owners of businesses who were entrusting me with helping them achieve their dreams. And so I left Peterson with a couple opportunities already in hand, really just going to this brand new world and putting up my shingle. And so in 2016, really launched Jacmel Growth Partners. We are an independently funded private equity fund. And so every time we look at a deal, we need to bring in our capital, not only the debt, but equity. We kicked off to a pretty good start, having acquired our first business in November of 2016. That company is named CSA Service Solutions. We actually renamed it after an acquisition to MSAR. The company is headquartered in Austin, Texas, 500 employees, been around 25 plus years, and we provide healthcare field services to hospitals and laboratories and other industries. So that was our first deal. Super excited to have gotten that off. And for that one, we partnered with a very large family office who came in and really provided a lot of the equity for that first company. The second business we acquired, which was in March of 2018, so call it about a year and 4 months or 6 months after closing the first platform, we bought a business named DRS Imaging Services. DRS is a 55-year-old document management company, 11 offices around America, 300 plus employees. We do a mixture of business process outsourcing, so a lot of BPO-related work in terms of document management, and we provide a unique and proprietary software solutions to companies such as American Express, Avis Rental Car, et cetera. So that business also has been doing, quite well, and we'll talk more about it, but both businesses are doing, relatively well during COVID. We're super excited to be in a better position than a lot of our peers out there. So 2 platforms under our belt, about a third business at the end of 2018, a small oil and gas services company called BMX Technologies. And so that brought us to our third platform, and we're now, looking around for different ways to continue our investment thesis, which is, again, to partner with owners and operators to really help them achieve their dreams. I'll pause there, Phil, just to make sure that I address your question.
No, that's great. It sounds like you guys are off to a phenomenal start, and congratulations on sounds like some really good businesses. And so I want to get into this interview a bit and pick your brain on a few items. And so, first is sort of broadly, what kind of opportunities are you seeing for business owners, particularly that are trying to grow in this environment?
Yeah. So so in situations like this, and candidly, also during '08 and other areas where there was economical turmoil, there are opportunities to grow and to really come out of a situation better poised than you were going into it. And that's something that we focus on every day with our businesses, with our daily conversations with our CEOs, is what are we doing today in terms of our plan to ensure that we come out of the COVID-19 pandemic in a better position than we were in before. So the first thing we've been focusing on a lot with our companies is really just getting the house in order. We're using this time, to some degree it's downtime, other degrees sometimes it is putting out fires. We're using this time to do some improvement processes internally, whether it's within our financial systems, operations, really managing through HR, whether it's setting up the right kind of pay grades, understanding what that upward mobility look like, just really taking this time to really go in and just really get your house in order to really come out again at the end of this in a much better position and for growth. We're also looking at this opportunity to candidly also grow through acquisitions if that pops up. Reputational wise and also doing the right thing. There clearly will be folks out there going out and just trying to take advantage of the situation and really come out on top in terms of trying to buy things super cheap and just taking folks who would normally not be wanting to sell, but using this opportunity to drive towards that. Just ethically, that's not how I operate. That's not what I want to tell my kids as to what did daddy do today as we're all working from home. So I'm mindful of just the ethics and just really mindful. Joel Peterson, again, the namesake of Peterson Partners, always said that the game we're in is a multi-generational game. It's not about the next deal you do. It's really about, for the next few generations, what are you laying out for your generations, your families, and the families of folks you're working with? And so super mindful about, taking advantage of people in general. Having said that, there are some owners and, operators who are, call it probably mid-50s, early 60s, no succession planning. This storm right now is really causing them to think about, hey, what do I really want to do with my time? Do I really want to run payroll? Do I really want to do this? And for those folks, we're happy to have very casual and open and fair conversations about, hey, is this the right time to think about it? And if so, happy to discuss. So I know that's something we want to talk more about as far as acquisitions in this time period. But so going back to your real question, which is about opportunities for entrepreneurs. I think there are opportunities to really just make your business much better as it is today. I think there's opportunities to really come out and just make sure you're communicating well with your investor base for them to know who you are and what you're doing and how you're managing through this. A practice that's worked well for us has been to have more regular updates. Whether it's weekly updates or bi-weekly, but just having a way to communicate to your investors how given the turmoil, you're still keeping your head on straight and you're still moving forward and very diligently, very thoughtful. I think that's just a good use of time right now. And I can assure you that most companies don't have that, so that will certainly help you as an entrepreneur really shine above your peers by showing the level of control you have as you're going through this pandemic.
No, I think that's great advice. The idea of being at the same time outward bound as you're communicating with external stakeholders. And then I love that your beginning comments around getting your house in order, putting systems in place, taking the time to be thoughtful about how to grow a business. I think you mentioned it, the idea of acquisitions. I want to pull on that thread a little bit more. How do you know if you're ready to go to that step? How do you know if you're ready as a business owner to do an acquisition? How should you think about it? And I know it's a long process around how do you source targets or valuations? And I don't want to get into all of that, but just sort of
Right.
what's
Right.
I guess, a simple framework you can use to help people begin to think about if it's something they should be considering.
Right. Yeah, absolutely. It's definitely a very, very long and detailed process and thought that goes into it. You walk into a situation with an entire amazing plan in place, and then you realize shortly thereafter that that plan is not going to work.
Mm-hmm.
So I guess to pull back, I would think that there's two ways to think about it. Either are you looking to be selling your business at this time, or are
Yep.
you looking to acquire? If we hone in on if you're looking to acquire another company, I think first thing you got to be just honest with yourself is to understand are your operations working well enough that you could go in and just add so much more, I'll just call it stuff, on top of it,
Yeah.
and still remain as efficient as you're currently running. So you think about it, if you take your existing processes and you increase your employee base by 25 or 30%, if that's something you can really take on. You have the right management team in place that can actually go in and just manage such a much bigger magnitude of work and duties. And if you're feeling like the team is up for it, then you're ready. And there's not, we can go through and create a bullet list if you want to, but really at some point it's going to come down to you guys think you're in a position to go ahead and take on a brand new set of relationships, brand new set of employees, and the headaches and turmoil that will likely come out of that. So you really have the bench in place to really take that on.
Yeah, I like that framework. Is there an example maybe of I don't know, you mentioned the idea of, hey, if you increase your workforce by 25%, I imagine it's going to cause some strain. But have you seen an example where that 25% increase in workforce, what specifically, where could it impact a business in terms of like systems and processes that a management team could be thinking about?
Yeah. I think. Yeah. So the thing that comes up a lot when you're pulling companies together, and we've done this, the last since the beginning of 2019, we've done this twice, where both of our portfolio companies, we went out and acquired another business, and essentially doubled our company size, both revenue and also, more importantly, employees. The first thing that comes into mind is reporting structure. Who reports to whom? Who's the boss? Who's driving the ship? What kind of communication do you have internally and also with key stakeholders, i.e. top customers and vendors, to understand that, hey, this is how things are working, and providing folks the assurances that nothing is going to go wrong.
Yeah.
So the communication piece is and understanding of that rolling of strategy. If Michael used to report to Susan, what happens on day 2? And just making sure that's all properly laid out. When I was consultant before business school, we called this change management. And I used to do a lot of change management implementations for one of the big consulting shops. This was a key aspect of the pre-shakeup, call it, communications plan and strategy, and the implementation of it and the post. If you think about a business that's running on, make it up 10 to 15% profit margin.
Yep.
The ability to go from 10% profit margin, so if you're making $10 million revenue, the ability to go from $1 million of profit to 0 of profit at 10% is so razor thin. And if you're running at 10%, that's because you've been doing it for a while. That's because you know what you're doing and everything is going really, really well. So if you're at 10% profit margin, you're buying a business that's at 10% profit margin, and you come in and shake up the communication aspect, the reporting aspect, you scare some of your customers, and you forget to pay some vendors on time, etc. Your opportunity for error to really mess things up is really, really high. Again, because you're only messing with 10% profit margin.
Yeah.
And so those are things you have to be just mindful of, right? That things are going to go wrong, and how much planning have you done beforehand for that to happen? Do that.
Yeah, I think that's and you kind of raised another question on mine, which is sort of the financial implications of an acquisition, and I would love to hear you speak on two sides. One is, what kind of internal financial systems do you need to have if you want to think about this, and sort of financial processes in place even before you go through an acquisition, and then as you're doing the acquisition, how do you finance it in such a way that you don't overburden the business, um,
Yeah.
with debt?
Yes. No, absolutely. Absolutely. So I'm anyone who knows me, I'm a very conservative user of leverage and debt.
Yep.
My years of training as a leverage finance banker on Wall Street has taught me that debt is awesome and amazing, but super risky. Seeing a number of situations where your lender will have the opportunity to become your owner.
Yep.
And so those are things you certainly don't want to do. And that certainly goes against the initial part, which is, helping entrepreneurs and owners achieve their dreams. Their last dream was to be owned by a bank. So
Yeah.
that's more of a nightmare. And so super mindful about that going into any situation. But in terms of your comment on the financial piece and how to think about it going in, and how to think about the use of debt, and candidly even some kind of equity that has
Yeah.
debt-like features on it. I think first and foremost, you got to know your financials. You have to have an understanding of how your business is truly operating. You don't have to be audited per se, but you should certainly have a good understanding of your revenue stream, your cost stream, what your fixed versus variable costs are. You should always know where is the fat in your business, the overburden that you're purposely carrying on, and what could you do to tweak that if need be. So basic financial reporting, whether it's using QuickBooks or not, is something key to understand.
Mm-hmm.
I've seen too many companies. I love businesses that are founder-run and operated, but those founder businesses, they have to only close their books once a year.
Yep.
Right? They often look to see the success of the business based on how much cash I have in my bank this month, which is great. It probably has more cash than I do in my bank account. But if you are closing your books once a year, you're not really seeing the true seasonality and movements within your company. And as you're thinking about putting together another business, you need to really understand that inner working. And so if you are a person who closes your books once a year, you might want to just get QuickBooks, pay some dollars to get a part-time, they call it fractional CFO, to come in and make sure you lay out your business in paper for you to understand exactly what's actually happening from a numerical perspective. But assuming you have that in place and you have a good grasp of where your business stands, clearly the next point would be to have a similar grasp on the financials and the metrics and operating efficiencies of your target. And then, it's literally 1 + 1 = 2, right? Just literally bring the two together and kind of understand, map it as if they were working together, what this would look like. Be very conservative, right? Don't assume that all of a sudden both businesses are growing at 5%, even pre-COVID, but we come together, we're going to be growing at 25%. Keep that for your upside case and don't show it to anyone. Just keep a regular base case. I often forecast my businesses as growing no faster than GDP.
Okay.
And if you're growing at GDP levels, do I still win? And then if things start falling down, what does it look like?
Wow, that's a good one. I like that. Don't grow faster than your base case should be not growing faster than GDP. I like that as a sort of a proxy.
Yeah, certainly you should definitely. It all depends, right? If your business has been growing at 15 to 20%, to say you're only going to grow at GDP does not make a ton of sense. But if you're just conceptually to think that you're going to be growing at some ridiculous, hockey stick, particularly after you do a major transaction, which we just talked about, you're going to have so many different operational and does Michael report to Susie or does Susie report to Michael issues coming up. Assuming you're going to have this ridiculous growth is likely misleading.
Got it. No, I like that. I like that a lot. And so, we've sort of gone down the path of a full out acquisition. Would love to. Some folks may think, hey, well, this, Nick, you're probably right. This may not be right for me. Short of an acquisition, if firms are thinking about partnerships, joint ventures, have you seen those be successful, and how have they worked? I guess in your experience, or situations you're aware of.
Yeah. Yeah, I'll say in my line of work, I normally don't see too many joint ventures.
Mm-hmm.
Partly being that I've going back to my days in Wall Street working at Macquarie Capital. A lot of the deals that we've been around, and particularly at Peterson Partners, if it wasn't us being the control, the new money going in would become the control investor.
Yep.
Definitely have done some minority investment deals. Those are just tend to be super hard, particularly when it comes to minority control and rights and things of that nature.
Mm-hmm.
So a lot of the deals I've been around have been more control-based deals. Having said that, there's been situations where we've gotten behind management and partnered with them, whether through JV or different means, because we really believe in who they are and what their plans were. So I'll start by saying that. I'll say the second thing about the JVs I'm just super mindful of too is that, at some point, someone has to be the decision maker.
Yeah.
Just in general, right? Same reason why, you often have partnerships that are with odd numbers, right? Boards have 3 or 5 or 7 seats, right? At some point, you need to have an ability to make decisions and to make them quickly to move, particularly during situations such as COVID-19. Being able to move is really, really important, and to not just sit and just debate things left and right. Having said that, there's a situation that we've been looking at with possible JV where you are, contributing assets into a new entity, a new co. New co will have a certain set of rules and the type of operations that new co will go after, and it likely will make sense for us to do. So again, I'm not as well focused on JVs in general, but if it's for a new business idea where it's really well structured as to, entity A is providing X, entity B is providing Y, and here's how everything will flow out of that, I think that makes sense.
Yep.
I would also say that in this day and age, I would think if JV makes sense, if you can find a way to make 1 + 1 = 3. Without that, I would question using a lot of time, effort, and energy in today's market where folks are really trying to hoard cash and keep people employed. If you're not seeing some level of arbitrage to be generated, I'd be curious as to why it'd be the right time to pursue a JV.
Got it. No, I think you've highlighted a good framework, which is, can 1 + 1 = 3, and more importantly, are roles and responsibilities clearly defined, and do you have some sort of way to have decision-making authority? And short of those 3 general criteria, the full-out effort of putting together a JV may not be worth it.
Yeah, absolutely. That's my take.
Yeah.
I will say that, one thing I've learned a lot, and I'll credit Joel Peterson on this again, and he has a couple of new books out about leadership and trust, et cetera. I will say as someone who's more of an investor, I do trust and believe in the leadership of my management team. They're the ones who are really down on the ground every day, actually doing work.
Yeah.
Right. We're here to provide some guidance and some capital, and spearhead M&A. But as far as the folks who are literally doing the work every day, it's your management team. And so I do provide a significant amount I lend a significant amount of trust and belief into what they say. I'll question and push back often, but if they really believe it's the right thing and we'll sit down and discuss it, at the end of the day, you are backing people. You are backing a management team.
Yeah.
That's what your money's being used.
No, and you're highlighting. So the investor management team relationship. This idea of the talent is paramount is something we see when we talk to founders, and sometimes we see hesitancy on the part of founders to, build out a management team and a very talented one, or they may not have the resources to do that. How do you suggest founders sort of think through that? I mean, the sourcing of talent, the incentivizing of talent, and the rationale of just putting the best people around you, and the magic that comes from when that works well.
Yeah, no, it's definitely magical when it works well. I'm not sure what the opposite of magical is when it doesn't work well. Maybe chaos. So both exist, and you're putting a bunch of type A personalities in a room and giving them equity ownership. And weird things happen sometimes when you do the wrong mix. think first of all, your leader and your owner, your leader and your CEO has to buy into it. I've learned the hard way, and I continue to learn the hard way because I'm very stubborn. I'm trying to get better, but I've learned the hard way to buy-in from your CEO and your management team, particularly your CEO. Then you're just really working aggressively hard unnecessarily.
Yeah.
So getting buy-in is important. Again, I go back to this. This is just how we view of investing, which is really partnership, right? Which is really partnering with your team. Certainly, as control investors, you can force things down, right? But
sure.
That's just not unless you have a full team ready to come in and take over the business, or you're going to invest in yourself. That's just not how you build long-term relationships with management teams. You're forcing things down people's throats. So going back to my comment, a lot of it is about guiding and providing examples and illustrations why this makes sense and what happens if you don't do this. So it's really just helping the management, particularly the CEO, buy into the view.
Yeah.
So, and what I see often, and you'll see this for a lot of companies call it under 20 million in revenue, where I kind of do a lot of my focusing, is, hey, do you need to have a full-time CFO or a part-time finance person, right? So much pushback on that. But when you show them, or hey, should I really jump off of, no offense to those on QuickBooks, but or a 20 or 30 million revenue business, it may be time to get off QuickBooks. But a CFO will ask you, hey, do I really want to spend $30,000 to $50,000 a year on the software tool for finance? Finance is back office. And so when you can kind of start showing, you consider it back office, but let me show you how you've been wasting money on X, Y, and Z, and look, the software pays for itself within 2 months by finding these issues. That's how you start building the buy-in and the trust and the belief that, okay, you know what, it's good to move forward with both technology and really better team members.
Yeah, I think you're what I'm hearing you describe is sort of the professionalization, quote unquote, of small businesses. Absolutely. And so, I mean, talk more about that. I mean, what does that look like for, hey, I'm a $5 million firm, or, I'm a $10 million firm and I want to get to that next level. It seems like people will plateau, but there may be things they can do or systems they can put in place that may help them, blast through that ceiling.
Yeah. So I think about it two ways. I think about it both from the top line perspective and also bottom line.
Okay.
And I mentioned that because, you can, to a point, you can generate more profit. If you can generate more profit without growing top line.
Yep.
And, the metric I tend to look at when I look at businesses is that I focus on your revenue. Then I focus on your gross profit, or growth, and then you focus on the EBITDA or net income, however you want to use it. Because I think if your cost of goods sold, growth process is defined properly, there's not much you can do to change that. I've never seen a situation where the person from Wall Street and investing, can come in and help a CEO increase his or her prices to customers.
Yeah.
Right? Owners and CEOs have a great pulse on the business of cost and cost management and how that would go over. And so having said that, so if you kind of look at your gross profit as being a fixed dollar amount, assuming no revenue growth, you're really now looking at opportunities to be more efficient with below the line.
Yeah.
Right? You have a sales team of 5 or 10 people and your company is only growing at 5%. You really need 5 to 10 salespeople, right? What are the true, right? Like, so what are they really account managers, which you get paid differently than sales, right? So those are the situations you kind of come in and take a look at, if it's taking you such a long time to onboard people, and analysis I like to do is, if I had more resources, could I generate more money from my existing customer base? If that's the case, then it sounds like you have an HR issue where you're not recruiting people fast enough. Or if you're recruiting them and turnover is, something that's much higher than what it should be, you're actually losing money through your recruiting process. And so, those are just examples of things you can do to kind of come in and tweak and fix stuff. I mean, it can get really simple also as you look at your days sales outstanding with your customer base, and, customer's supposed to pay you net 30 and they're paying you net 120. That's 90 days of money of loss you're having because of the working capital being stuck in the business. Well, not to get too financial nerdy. Love this stuff, but not to get too much into that. There are ways to improve your business both in the top line, profitability through top line management and growth, and also through, call it, below the line. And so there's a lot that you can do below the line that a lot of companies don't look at. Having said that, if you are a $5 million revenue business and you're kicking off $1 million of profit, unless you're a software company, it's really hard to kick off more than 20% from a services company. So you're doing pretty well, and so from there, then it's going to be tied to, hey, how do you grow your top line? And for that, I mean, there's seen a number of things work. I've pushed through a number of different areas, but it really varies on a case by case basis, depending on the industry, depending on the company, depending on the competitors. There's so much that it'd probably be a longer conversation to talk about how to drive top line growth. But I'm happy whenever you want.
Yeah, I'm curious. Part of me is like, we got to get you back to talk about that. I wanna dig into it so bad. I mean, so I think what I've gotten out of this conversation is just how beneficial it is to have sort of a partner, particularly one like you guys that is so thoughtful, that has capital. So if owners want to try to approach you or a firm like yourself, I mean, how do they position themselves to be a good candidate as someone who, should be in a partnership with you guys?
Yeah, I think so. There are two answers to that question, and I'm going to cheat and give you both of them.
Sure.
The first answer to the question is tied to if you want to make yourself really attractive to a private equity shop, what should you look like? Right? Super easy answer.
Yeah.
We can go through that. The second piece I want to be more mindful of is I personally enjoy finding companies that are not that attractive to private equity.
Yep.
Because that's really, honestly, that's where I make my arbitrage. And so, because once you're super attractive to finance private equity firm, then you have way more options, and you've done a lot of the hard lifting and hard work that we just talked about in this call. Those are things that you would have already done, because that's what makes you attractive to a PE shop. And so, in terms of attractiveness to a PE shop, again, not to get too nerdy, but let's go down the P&L. Consistent revenue, whether it's revenue growth of 3, 5, 10%, that's way more attractive than a company that grows 20% this year, loses 10% next year, and
Sure.
just fluctuates all over the place. So consistency in revenue is really, really helpful and really important, because, especially if, like most PE shops will put debt on your business, that's when they buy you, they're going to want to make sure that the company has steady cash flow to service whatever it is that they put on there. And so revenue consistency is really important. Margin consistency is really great, meaning we talk about gross margins, you now have a process in place that helps you understand you sell your service at a certain rate. You know how to execute it at a certain rate to generate a certain amount of gross profit that comes along with it. So those are, just being consistent is really helpful there. Folks will say that, hey, you should try to make your business be 30 to 40 or 50% gross margin. Honestly, let your business do what it does. Different industries operate differently, right? If you're in the outsourced space or call it contact center space, you're not going to generate 40 to 50% gross margin.
Yeah.
That's just not the business model. But those are still very attractive businesses if done well. So consistency in that is really important. If I keep on going down the P&L, I think corporate or SG&A costs is also really, really important to think about. If you think about your cost of goods sold as being more variable, your SG&A is likely more fixed. And so, having too much fixed cost is not a good thing.
Sure.
Because that means in terms of a downturn, you're really, really screwed. You're upside down. And so having the right size and more variable as you can get into SG&A is also really important. And then, a lot of PE shops like to look at asset-light kind of businesses. So if you think about, heavy CapEx spend and heavy investment needed to maintain your business, the less the better. That makes you more fluid. But so SG&A be mindful of, and really CapEx spend and and other things of that is also going to, the lower that cost, the more attractive you are to a possible financial buyer. And lastly, I think a big thing though that just really it's crazy how simple it is, but you have to always remember as an owner and operator, you are way smarter about your business, your industry, etc., than any investor looking at it.
Mm-hmm.
And so, so to that end, it is up to you to go out and really pitch the story the way you want to pitch it in a way that just makes it sound very, very attractive. You can sell a business that is not in a growth industry pretty well if you just understand the story and you share it properly. This is why you differentiated. You're differentiated. This is why you're able to grow in a down market. This is what you're doing that makes you different from your competitors. And this is how, if the industry is growing at 3%, this is how we've been able to manage growth at 5 to 10%. So there's a lot that comes into storytelling once the numbers are down that will help make your business more attractive. And the last thing I'll say is that, if you really are considering taking on outside capital, it likely behooves you to spend time with an advisor.
Great recommendation.
The way I think, and again, as a buyer of businesses, when I see an advisor on the other side, I say, a few choice words in my head. But if I'm advising a friend who's selling his or her business, I think you should take time to make sure you at least speak to an advisor to understand, is there a way that the advisor can come in and actually help make you money, right, by helping you tell the story better. And then you can also easily structure your compensation plan for your advisor so that that person only eats if they actually deliver a very good job to you.
Yeah. No, that's great. And I think that's a great advice to get advice. And so I know we're limited on time here, so I think we have to wrap up. I hope we get to have you back to chat more about just a ton of these topics. But before we leave, anything you want to share with us or with the folks listening before we hop?
Yeah, absolutely. Well, first of all, if there are folks that are listening into anything being put out by Melissa and Phil, just by default, you have access to me also. So if you reach out to Melissa and Phil, they'll
we appreciate
my contact information. Yeah, so that's just for family. I extend that out to. So anyone who Melissa and Phil talks to is family to me too, because they're definitely family. That's first and foremost. Feel free to reach out. I'm happy to be helpful. Secondly, one thing that I see it happening. We're mindful about it too. During this time period, so we talked about how to grow and how to do more. You can certainly grow and add more value through acquisitions. So I hope nothing I said should say that you should be shy of the acquisitions. It should just be that you should just be ready for it and be ready to absorb it and ready to have the team around to do it. But certainly there are, of the 30 plus million small businesses in America, a number of those owners are likely looking for a situation to respectfully exit the game. And so, those are situations I'm always on the lookout for myself. And again, I go back to this concept of respect because I do think, as humans, we shouldn't take advantage of people right now.
Yeah.
So if you can find a way to respectfully pull together the right kind of deal, this is the time that you can make some transformational changes for your business.
That's phenomenal.